Welcome to Spring into ETF Investing. On today's special episode, our panel of guest speakers will be discussing sectors to watch in 2024.
This is ETF Market Insights, and I'm Erin Allen, VP of Online Distribution with BMO ETFs. Welcome to the channel. For those who are new to our channel, our goal is to provide timely market-related insights and ETF-focused education to Canadian do-it-yourself investors with the goal to become your trusted partner in investing. We want to bring you access to the same level of high-quality resources that advisors and institutions receive in our industry. Before we begin, a quick reminder that today we are not providing you investment advice or recommendations. Our channel is all about providing education around investing and around ETFs. And now I'm going to turn over my hosting duties to Sejal Patel, host of the Strictly Money podcast and YouTube channel, where she helps Canadians master their personal finances. Sejal is a financial analyst, award-winning business TV journalist with CNBC and BNN previously, and a publicist with more than 20 years of experience in the financial industry. We're excited to have her host today's session. Sejal, over to you.
Welcome to our discussion today, where I am joined by some of our industry professionals to discuss what sectors to watch in 2024. With tech and the Magnificent Seven leading the change, we'll explore what's driving their growth, geopolitical risks, interest rate environments, and much more. With me today, I have Chris McKinney. He's a portfolio manager with BMO ETFs, and Valerie Grimba, who is a market maker at RBC Capital Markets. So welcome both.
Thank you.
Happy to be here.
So Chris, let's start with you and ETF fund flows. I think we can both agree that the sector that got the most love was technology. Can you talk a little bit about what was driving the dominance there?
Sure, and you're right. Technology is the sector that's been getting the most investor love, so to speak, so far this year. If we look at flows in the US industries, so year to date to the end of April, technology sector ETFs have brought in $11 billion. And there's really no other sector that's close to that in terms of the magnitude of flows coming in. We see on the top, other than tech, there's been financials and energy getting a little bit of flows more in recent months. So that's an interesting phenomenon there. A little bit cyclical sectors getting some flows, but again, nothing really matches what's been going into technology right now. As for the factors that are driving that, you really have this continued momentum around this AI movement. And it's not from the technology companies themselves, but we have a few quarters now of other CEOs and other industries talking about AI, how they're using it in their business and how they're going to deploy it to either gain efficiencies or add value in some other way. And so when you have companies in the financial industry, communications, consumer stocks, all talking about this adoption, it's a real big build out. And the beneficiaries, of course, are those technology companies, whether it's the chips to run AI models, whether it's someone running an AI model themselves, or all the other infrastructure that goes into that. All roads lead back to those technology stocks. And so that's been a really big boon for them so far here this year. Also, we have the continued resilience of the US economy in general. We went into the year thinking there might be a recession, several rate cuts potentially because of that, and we've seen economic growth continue. And I think that just boosts investor confidence in general. And technology as the sort of risk-on sector tends to be the beneficiary of that.
Valerie, let's talk about the Magnificent Seven, which when I look at it, it's actually contributed about half of the S&P index's returns. How are those stocks influencing the market dynamics?
Yes, listen, the Magnificent Seven have been such a powerful momentum force within this market for the past 18 months. No doubt they have been the key drivers of a lot of US equity performance. And the reality is that to a certain extent, they're here to stay. The S&P 500 is as concentrated as it has been in the past decade right now. The top 10 stocks account for nearly 35% of the S&P 500. So no doubt kind of where those stocks go, probably the broader market will go as well. Magnificent Seven year to date, yes, they've been big contributors, but when you drill down into it, it's really about the Magnificent One, that stock being NVIDIA. It's up 90% year to date, and it has been a big driver of kind of the overall performance. And that again is to what Chris was talking to, is this AI secular growth trend. They've been a big beneficiary of that. The numbers have backed up the growth story, and investors have rewarded the company accordingly. Now, we have seen kind of valuations go up as these companies have grown larger. And some might say that right now they might be priced to perfection, or they need to keep delivering on strong growth to kind of see valuations or stock prices rally from here. You might want to consider looking forward as well. There might be a future where we see kind of a rate cutting cycle come into play, which I think we'll discuss further, but it could cause some kind of market rotation there as well. And you might see some of the other areas of the stock market that have been lagging sort of take a leadership role here. So I think there's a lot of interesting dynamics at play, and you probably ideally want to have exposures to both ends of that story.
Yeah, let's talk about that, Chris, because there are some headwinds in the tech sector. There's certainly some regulatory scrutiny, especially when it comes to AI, privacy concerns, as Valerie mentioned, valuation concerns. And at the same time, you're seeing some market volatility because people are questioning the timing of the interest rate cuts. So for investors who want to see growth in their portfolio, but they still have to navigate the market volatility, what do you suggest? What sort of strategies can they use?
Yeah, there's a few things investors can look at, and your point is well taken that particularly recently, we've seen a little bit of moderation from the technology sector in terms of their performance. Certainly it has been strong, but in the last month or two, we've seen a little bit of softening there. If we look at the most recent earnings cycle, companies like Meta Platforms / Facebook delivering pretty negative earnings, whereas Google or Alphabet in the same space, same subsector, very positive earnings. And so even within a sector, you can see this differentiation between companies. And so, just using sector ETFs in general, I think speaks to a great way for investors to tackle that diversification element that everyone knows about ETFs provide, even within a narrow sector. Utilizing a sector ETF rather than trying to pick one or two companies helps to reduce that overall volatility. One other thing investors could look at, especially if you're thinking about a potential moderation of growth going forward, is to utilize an ETF that provides a covered call overlay. And for investors in Canada, there are lots of covered call strategies on sector-specific underlying portfolios, and technology is one of those where you can get a nice income stream on top of the growth potential that technology companies provide. And that allows you to reduce volatility within the portfolio a little bit as well. So that's a couple of strategies investors could look at. And of course, the other, if we're talking about technology, you've probably had a pretty good run, pretty good returns from that sector. Maybe you can take a little bit off the table there and rotate into another sector. I mentioned energy and financials getting some interest and flows recently. Those sectors really have different drivers than technology does. And so that's a nice diversification element there, a complementary sector on top of the technology, and that helps to ride out that volatility as well.
Good stuff. Let's talk about some of the big themes that are affecting the markets and sectors. Valerie, you mentioned interest rates. The timing of interest rate cuts are still up for debate. What sectors are going to benefit positively, and then what sectors could benefit or not benefit? They'll be impacted negatively.
I mean, it is the $1 million question here right now. All the portfolio managers, investors are trying to feel out, when are we going to get this inflection point? We've had a very steep tightening cycle. We've seen rates go up quite dramatically, very quickly, and everyone's been waiting for that to kind of trickle down through the economy. Now, it's kind of economics 101, but really these central banks want to see a bit of pain at the ground level. They want to see kind of some job losses, GDP and growth to slow down, giving them the ability to kind of fire off the biggest tool in their toolkit, and that is to begin this rate cutting cycle. Now, rate cutting cycle is stimulatory, right? That's what it should do. As we get in these looser financial conditions, people can go out and spend more and borrow more freely, so can corporations, and you should have this kind of broad-based kind of boost as this cycle kind of feels itself out through the market. But there will be certain winners and probably sectors that underperform in that environment as well. And so the area of the market we would want to look at is cyclical sectors. And this makes intuitive sense, right? These companies within cyclical sectors kind of ride the tide of the economy, right? So they're kind of high when the economy is doing well and maybe ride the tide downwards when the economy is doing poorly. So if we expect to see that change towards a growing economic cycle, then we would want to be invested in cyclical sectors. So kind of what are those? It's consumer discretionary. People can go out and spend. It's financials, it's energy, materials, and industrials. These are kind of your in the ground type companies that will benefit from the most from a growing economy. And then the flip side of that coin is the defensive sectors. So these probably would underperform. So that's consumer staples. If you think about it, we've seen Costco and Walmart do really well recently and through this tightening condition. So they might underperform when things get relaxed.
Chris, another theme that a lot of people are paying attention to are global elections. So we had elections in Russia as well as Taiwan. Now people are focused on India and the US and what unfolds there. How do you think that's going to impact markets?
Yeah, the other big question on people's minds, of course, what's going to happen with this big election coming in the fall? I think one thing that we can think about is obviously, it's very hard to predict who will win this election, and in particular in the US, I'm talking specifically, we see many polls that are very close, and so it's hard to predict what the outcome of that's going to be, as well as what the outlook is for the rest of the government as well, and the Senate and the House of Commerce. And so I think one thing we can take away is that regardless of which party wins, likely we're going to see continued inflationary pressures from fiscal policy, whether that's through tariffs, which we're already seeing from the current administration, the new administration, or the prospective Republican as well is talking about a lot of tariffs as well. And so that trend is going to continue, and that's going to keep prices relatively high. As well, Democrats want to continue spending as well, and that could have inflationary impacts also. So it's kind of hard to predict, again, what's going to happen and what the result will be. But I think one thing we could take from elections, if we look in the past, is that they introduce volatility. We're pretty certain that there will be higher volatility this year, as there generally is in election years. And one thing that's interesting this time around is that if you look at the futures market for VIX, the market is already pricing in higher volatility around November. And that's pretty rare for this time of year for the market to already be pricing that in. So really, the market participants are already telling us there will be higher volatility this fall. And so I think what investors should do is think about how they want to ride out that volatility, if they're happy to take that on because that is opportunity as well, or if they want to take strategies to maybe reduce that volatility in general. One thing we do tend to see in election years is an increased flow into short-term fixed income. And one thing that we can get this year that we might not have had in past election cycles is a nice yield out of that short-term fixed income. You can get 5+% from ultra short-term ETFs right now. And so that's not a bad place to hide out. If you want to take a little bit of your risk off the table, put it into that short-term fixed income, earn a nice yield on it, and then you have some of dry powder to put back to work depending on what the results are of the election, depending on what your thesis is. You can get that money to work fairly quickly. The other thing investors could do is just look at alternative asset classes or alternative strategies. And I'm thinking about things like gold, for example, very uncorrelated to both fixed income and equities, but could be a source of return for investors. And so gold could be a decent allocation in terms of return potential. And that also helps address the potential inflation concern I was talking about. Regardless of which party wins that election, that inflationary pressure could continue, and gold would be a nice hedge against that.
Valerie, are you seeing geopolitical tensions affect certain sectors more than others? And do you think that'll continue?
Yes, unfortunately, there is a lot going on geopolitically. We've got a number of conflicts, issues like tariffs that Chris brought up as well. So there's a lot for an investor to consider. Fortunately, we haven't seen impact of conflict yet on the US stock market. It's operated relatively agnostically here. Corporate earnings have been growing, and the stock market has followed. But where you have seen the impact of geopolitical tensions is in this commodity space. So we've had crude prices go up almost 20% earlier this year. Gold hit an all-time high. Silver is up even more on a percentage basis. And we've even seen copper rally 20% this year. So these are big moves for the underlying commodity prices. And we have seen the trickle-down effect to the related equities. So that would be the energy sector and the material sector. Now, obviously, these are companies. They have a lot more going on operationally. But net, higher commodity prices should help their bottom line at the end of the day. Another thing to consider, if you think that geopolitical conflict is going to escalate or stay elevated here, is that kind of pressure coming from higher commodity prices. So the one way we back into that is that energy has a very big impact on inflation data. It is a big input into the inflation numbers that central banks look at. So if you expect oil prices to remain higher on the back of maybe escalating or continued geopolitical tensions, that could have wider reaching implications through to central banks' movements and maybe even push out that timeline for the big interest rate cutting cycle that everyone is kind of on tenterhooks trying to pinpoint when exactly we're going to get that. So it's a bit chicken and the egg and a bit far reaching there, but I think it's an important consideration when we talk about what's going on geopolitically right now.
So Chris, for investors who want to use ETFs to gain exposure to certain sectors, as you know, some of the sectors that even Valerie had mentioned, what are some of the considerations? What do they have to look at?
Well, I think first of all, investors should look at their existing portfolio and determine how much exposure they already might have. And I'm thinking, you know, if you have the S&P 500 in your portfolio, you probably have a decent weight to technology already. Or if you have the Canadian Composite, for example, you probably have a lot of financials in your portfolio already. So understanding your current exposure helps you decide that sector trade that you're going to put on. The other thing, I think once you've decided, okay, I'm going to go into X sector and this is how much I'm going to go into, you really want to take a look at the composition of the different ETFs within that sector and what the weighting methodology is of the index or ETF that's tracking that sector. In particular, in Canada, if you're at the sector level, you could get very narrow representation, as few as 10 stocks perhaps in some sectors or even smaller. And so if you're looking at a market cap-based ETF, that could be dominated really by only one or two stocks. Whereas an equal weight ETF will give you exposure, obviously equal exposure across all of the companies in that sector. So that rounds out the sector exposure a little more better than a very top-heavy market cap-based sector ETF.
Okay, so before I wrap up, I have to ask you both, what is the number one sector to watch in 2024 and why? I'll start with you, Valerie.
So it's a perfect segue. Thanks for teeing it up for me, Chris, but is energy. There is a lot to like about energy. We like it from both a top-down macro analysis and also bottom-up. So our team of research analysts that cover energy stocks specifically, they have said they've kind of never felt more favorable towards the sector in the past decade. They are entering their financially prudent era. And a result of this capital prudence is that they are generating a lot more free cash flow. And that is a boon for investors, right? Because then they can boost shareholder return through this free cash flow generation. So you're seeing that through special dividends, the actual dividend, which the sector is now paying out close to 4%. And again, on just stronger deleveraged balance sheets. So kind of like the financial health of the sector is a lot better as well. And then from a top-down perspective, first of all, Chris mentioned kind of a sector exposure within an index. Energy is very, very small percentage of the S&P 500. It's a little bit larger here in Canada, but again, it's a smaller percentage if you own kind of a benchmark index. So it kind of gives you that toggle there and can actually kind of provide a bit of juice to returns. And then, of course, we have all of the tailwinds that we discussed already. You know, energy tends to do well leading up to a US election. It has a bit of a value tilt. It does well if geopolitical issues worsen, so it provides a bit of insurance there. And valuations are super favorable. They look great on both a relative basis and an absolute basis. Again, it kind of trends towards that value side of the equation. But we think that from both perspectives, there's a lot to like about owning energy here for the balance of 2024.
Okay, so energy's your pick. Yours, Chris?
I'll have to go with financials myself, and particularly I'm looking south of the border. I think financials in general have started to benefit from this higher interest rate environment that we're in. We've also talked already about continued inflationary pressures and potential for interest rates to stay relatively high, even if we do see a few cuts in the near future. But financials do tend to benefit from that higher interest rate environment and the normalizing of the yield curve. We have this inverted yield curve right now where short-term interest rates are higher than long-term interest rates. That's not beneficial for financials, but as we start to see that start to shift, as we get closer to these interest rate cuts, that yield curve will start to normalize, and that will benefit financials, again, particularly south of the border. In the S&P 500, they do not make up a big part of that index. And so if you have that broad US exposure, you're not loaded up on financials already. And so, entering probably a favorable backdrop might make sense to add some financials into the book.
Thanks, Chris. Well, that covers off our discussion today. Thank you so much to Valerie and Chris for sharing their insights. To summarize, amidst notable uncertainties such as the US election outcome, geopolitical issues, and the timing of rate cuts, investors would be wise to stay informed, diversify, and seize upcoming opportunities. Thank you for joining us as we explore the dynamic landscape of this year's key sectors. And a special thank you to ETF Market Insights for bringing us together to host these educational segments for investors. Thanks for watching.